Imagine waking up in early 2028, and the familiar rhythm of your financial life stutters. Your paycheck arrives late. Your rent payment bounces back with a cryptic processing delay. And overnight, the price of groceries, fuel, and transport jumps without warning. News anchors offer calm explanations. Technical issues, routine adjustments, temporary outages. But beneath the surface, something far larger is moving. Something coordinated. Something global. A shift in the architecture of money itself, happening quietly, while billions carry on unaware. It isn't the United States. It isn't Europe. It isn't even the rising giants we usually imagine. It's a coalition of nations many overlook, yet each with the capability, motivation, and leverage to act decisively when the world hesitates. Because the real question isn't, can the financial system change? Would you even notice until it was already in motion? And by the time the world realizes it, the foundation of global finance may have already been rewritten. To understand 2028, we need to travel back nearly a century. Since 1944, the US dollar has been the backbone of global finance. Bretton Woods didn't just create a system, it created an era. An era built on stability, predictability, and the promise that one currency would anchor the world. Even when the gold peg broke in 1971, the dollar didn't fall. It adapted. It became stronger. Markets learned to trust it not because it was perfect, but because no alternative felt safer. But financial historians know something most people don't. Trust rarely collapses suddenly. It thins quietly, invisibly, over decades. Debt grows. Geopolitical tensions rise. Technological alternatives emerge. And confidence, the invisible fuel of the global system, begins to weaken. Not enough for panic. Not enough for headlines. Just enough for cracks to form. And when those cracks reach the right pressure point, the ripple touches every nation, every market, every household. Which forces a question few dare to ask. Could the system we depend on be eroding right now, without most people noticing? Money is not metal. It is not paper. It is not digital code. Money is trust. A shared promise that value will be honored tomorrow. But when trust thins, costs rise. Interests spike. Volatility spreads. And uncertainty becomes a tax on every business, every mortgage, every family. Picture a small business owner, waiting for a routine refinancing to keep operations steady. Suddenly, banks hesitate. Rates fluctuate. The certainty of next month becomes foggy. Or a family that has budgeted the same way for years, only to see their monthly expenses shift unpredictably. When trust weakens, dependence becomes risk. And risk touches everyone. Because the real fragility of a financial system isn't found in charts or spreadsheets. It's found in the invisible confidence holding those numbers together. And the world is entering a phase where that invisible confidence is no longer guaranteed. Every financial era has a breaking point, a moment when the system reveals its fragility. Now imagine a single morning. Bond auctions slow. Global payment systems hesitate. Shipping insurers pause coverage as currency risk spikes. And central banks issue unusually vague statements. It lasts only minutes. Maybe an hour. But for the people watching closely, the message is unmistakable. The heartbeat of global finance just faltered. In this fragile pause, some nations had already prepared their move. They had watched the early signs, measured the pressure, assessed the risks. The question was no longer if the system needed an alternative, but who would build it first. It wasn't a rebellion. It wasn't a secret plot. It wasn't even an attempt to challenge the old system. It was necessity. 6 nations, each with unique strengths, arrived at the same realization. The current system could fail them. Singapore, a precision-driven financial hub with unmatched regulatory discipline. The United Arab Emirates, a global energy gateway, where every barrel of oil moves with strategic intent. India, a demographic giant with growing technological and economic weight. Brazil, a resource powerhouse with influence across South America. South Korea, a manufacturing and technology leader with deep integration into global supply chains. Together, these countries didn't form an alliance to dominate. They formed an alliance to survive and to stabilize their economic future. But forming a coalition is one thing. Agreeing on shared rules, shared incentives, shared architecture is something else entirely. And it's inside that delicate alignment that the potential to rewrite the global financial game begins. What happens when capability meets opportunity? At the exact moment the old system begins to wobble. This shift didn't begin with secret meetings behind closed doors. It began with public pilots, incremental experiments, quiet bilateral discussions, all visible, yet unnoticed, because the world wasn't looking. Picture a cross-border energy payment between two of these nations. Instead of routing through multiple intermediaries, settlement happens almost instantly. No delays. No correspondent bank fees. No exposure to dollar volatility. What began as engineering became strategy. What began as a payment became a proof of concept. Could this small pilot withstand scrutiny? Could it scale? Could it support billions in trade flows? If the answer was yes, the implications would be historic. Slowly, a new financial network begins to take shape. Real-time settlements, shared rules, reduced dependence on any single currency anchor. No ideological mission. No attempt to replace the old system. Simply a practical alternative. Imagine a South Korean manufacturer paying a Brazilian supplier, not in dollars, not through a 3-day process, but instantly, with no currency risk. Efficiency begins to outcompete tradition. Practicality begins to outpace pedigree. And history shows a pattern. Once a new system becomes easier, cheaper, and more predictable, adoption accelerates long before incumbents are ready to respond. Then, imagine it happens. A coordinated series of statements from the six-nation coalition launches the network globally. Energy transactions begin routing through the new system. Mineral exports follow. Manufacturing payments shift. And technology supply chains integrate almost overnight. To the average person, the headlines feel distant. But businesses start noticing delayed invoices. Retailers experience unpredictable import costs. Families see price fluctuations without clear explanations. Your daily expenses, your income timing, your financial stability, all now influenced by a network you've never heard of. If the rules of money change silently overnight, what choices would you make? Markets hate uncertainty. And the birth of a global alternative system sends shockwaves everywhere. Currencies swing wildly. Gold spikes. Bond yields jump as investors scramble for clarity. Analysts debate endlessly. Some predict collapse. Others predict transformation. But one truth becomes undeniable. Once a viable alternative exists, the dominance of the old system is never fully restored. Now the world confronts a split reality. Will the traditional financial order stabilize itself? Or will the shift intensify? And more importantly, who benefits from the chaos? And who pays the price? Then comes the tipping point. A handful of additional nations join, not for ideology, but for stability, for predictable trade flows, for lower transaction costs, for insulation from geopolitical risk. Suddenly, what began as an experiment becomes an ecosystem. Two parallel monetary systems emerge. One built on the legacy of the 20th century, and one built for the realities of the 21st. As adoption spreads, momentum becomes unstoppable. Businesses integrate. Banks adjust. Governments recalibrate. And now the world must ask, who will continue relying solely on the old operating system when a second one offers resilience? Every financial transition creates winners and losers. Export-heavy economies find new predictability. Energy producers gain unprecedented leverage. Growing markets gain insulation from foreign currency shocks. But heavily indebted nations face tougher borrowing conditions. Their interest costs rise. Their fiscal space shrinks. And for ordinary households, the consequences become painfully real. Inflation shifts. Loan rates become unpredictable. Job security tightens as companies adjust to new cost structures. It doesn't matter where you live. Your personal finances are now tied to global decisions you never voted on, and systems you never see. The stakes are no longer theoretical. They are personal. By the end of the decade, the world could resemble a device running two operating systems. The dollar-centric network persists, powerful and familiar. The alternative system grows steadily, integrating more trade flows, institutions, and infrastructure. Financial power becomes distributed. Businesses choose which network to operate in. Governments navigate overlapping currencies. Individuals adapt to a world where savings, investments, and costs move according to two rhythms. This isn't a takeover. It's coexistence. A dual reality. Navigating it becomes a new skill of the modern world. What some may one day call the financial coup of 2028 would never look like a coup in the traditional sense. No battles. No collapse. No dramatic headlines. It was a transition point. A silent pivot in the architecture of global finance. Nations sought stability outside an aging system. Technology outpaced policy. And alternatives emerged not from ideology, but from necessity. From Bretton Woods to the creation of the euro, history shows something consistent. Financial shifts rarely announce themselves, but they shape ordinary lives far more than political speeches or election results. Systems change quietly. Preparation changes loudly. The real question now is simple. Will you recognize the architecture shaping your life before it arrives? If this revealed something deeper, subscribe. The patterns of history never lie, and I'll guide you through them.